We have a slew of guests joining us to talk to us about what they make of the overall announcements that have come in. Nilesh Shah joins us to talk to us about that, Tewari from SBI, and of course we also have Harsh Dugar joining us from Federal Bank to talk to us about just that. Let me begin with you, Nilesh. Market seems to be giving it a thumbs up. What's your view? Because, of course, overall the commentary on rate was expected, but the way he talked about India and the fact that we are holding up much better than other economies definitely gives a vote of confidence.
Well, I think if you look at the opening state of RBI Governor, that global growth is fragile. There was a time when India was in fragile 5 economy and global growth was doing well. Now global growth is fragile and we are doing well. That's exactly what is reflected in markets, both debt, equity, as well as currency. Growth has been ahead of estimate. Inflation, though elevated, is still within RBI's target range. Banking system is healthy with one of the lowest NPAs. Deposit and credit growth is still in double digit. Oil prices, which normally is Rahu or Ketu in our Kundli, despite production cut, has remained subdued below $80. Monsoon, despite initial worries, have recovered reasonably well. It is little below long-term average, but not substantially large. So everything seems to be coming in order for India, whereas the world is going into a troublesome phase. And that confidence is reflected into the market.
Right. Mr. Dugar, wanted to get in your take on the same as well. Going by what the RBI governor has announced, it is pretty much on expected lines. And given those healthy growth projections, in light of the fact that at a time, as Nilesh alluded to, that the governor acknowledged that global growth is looking fragile, how are you looking at the India story that has been laid out on the macro front?
Quite well and extensively. I think we are an island of hope, optimism, stability, and growth, which is against a global backdrop of the good part is the globally, at least, the inflation seems to be taming off and rates seem to be easing off. The good part is also the commodity price, including crude, is also stabilized and coming off, which is helping the corporate world in terms of lower input prices. So I think all in all, if you look at it from a asset quality, growth, credit growth, I think all these factors bode quite well, which is also quite reflected in the markets as well, the stock markets as well. So all in all, if you ask me, this is largely expected also of maintaining the repo rates, which is what the RBI has rightly done also. Inflation seems to be seemingly under control, while the governor has insisted on the point towards the end that he's still looking towards 4% in terms of on the long medium term to stabilize that. So between growth, inflation stability, and exchange stability, I think we are as a country quite well placed.
Quite well placed. Let me bring Mr. Tewari also into the conversation. Mr. Tewari, what do you make of the liquidity commentary coming in from the governor that system liquidity actually turned into the deficit mode? No OMO auctions were done and they have allowed the reversal of liquidity facilities on SDF, MSF as well. What do you think would be the implication for the banking sector for all of this?
This is a good step for the banking system because the deficit was there clearly, and for us to place deposits and then be locked out for the weekend or for any other holiday in between was a bit of a difficulty, and therefore by opening this has really eased things for the banks, and hopefully we will have much more flexibility going forward under this norm. As he has acknowledged that for the month of October, the liquidity was in deficit mode. So this will be a flexible thing for us, a good thing for us generally. And as the inflation comes more under control and on a sustainable basis, I think then the next steps for easing liquidity might be taken.
Mr. Tewari, anything else that stood out for you in the commentary that the governor alluded to, whether in terms of the web aggregation and the digital lending, or the fact that there would be this cloud setup for, in India itself, back home, to maintain the data security and privacy?
Important announcements, and actually for the last several times, we are more focusing on the additional measures announced because they are far more significant sometimes when the rate is not changed. So the cloud announcement is really, really significant because most of the banks are struggling with the clear decision as to what to do with cloud. Like for us, we have a very extensive, large owned cloud on by ourselves. But considering the high volume of transactions, especially in UPI, there is this need to actually go on a public cloud. And we were debating as to whether we go on a hybrid version or a entirely public cloud, etc. And now with the RBI coming up with this announcement, I think it is good for the industry. Even if the UPI part of it goes on the public cloud, which is set up by RBI, it will be a great help to most of the banks to handle the large volume of transactions on UPI, which put immense pressure on our own systems, etc. So that's a very good announcement. On the fintech side, I think those are needed because the world of digital lending, where small value lending is being done by a lot of fintechs, and the web aggregators, which is the main announcement, where they will also be regulated now, which were suggesting which provider to take or which loan to take. I think all the entire ecosystem has now been brought under regulation, which is a good thing, because ultimately the people who take these small value loans are the vulnerable sorts, and therefore they need to be protected. And going and adding that to the whitelisting of apps, which is being considered, I think this will go a long way in handling all this digital fintech lending space, make it safe, and also encourage innovation on the fintech side.
Fair enough. Nilesh, would you concur with that? Because clearly the RBI governor stressed on regulations on digital lending, web aggregation with respect to the enhancing the UPI transaction limits, etc., cloud facilities, and yet talking about how it is, setting up as well a fintech repository. How have you read into all of these statements and this real focus on digital and tech?
As Mr. Tewari mentioned, regulator's job is to create the guardrail. So when we throw the ball, it doesn't go outside the guardrail. Undoubtedly, the world is digitizing, and India has generally been ahead of the curve than the behind. Now, it is extremely important that on one side, we allow digitization to reduce cost, to increase coverage, to improve efficiency. But at the same time, we need to build guardrails so that it is not, used unnecessarily. It doesn't result into mis-selling. Combination of all the steps taken by RBI will ensure that India's banking and financial services continue to stay ahead of the curve on digitization. It will lower the intermediation cost. It will increase the coverage. And at the same time, mis-selling will be reduced. So prudent regulator, as RBI governor mentioned, will act in advance and proactively rather than after event has happened.
In his own words, they don't wait for the fire to be there to catch the fire and then act. They act preemptively, and that's been the case over the last 2 to 3 years as well, when we have seen that the RBI has been much ahead of the rest of the globe. But do you think, Mr. Dugar, RBI is going to be ahead of the curve in terms of cutting rates as well? Because that's, of course, the next thing to watch out for. There was the latest note that talked about that probably from Q1 itself of next financial year, we'll see that. Do you see that happening pre-election or post-election? Mr. Dugar, the question is for you.
No, I completely missed it. There's a connectivity issue. Could you just repeat that, please?
Sure. Now, I wanted to get your assumptions in terms of when the rate cut cycle would begin.
I think it's obviously a function of a couple of things. Honestly, the factors bode well. They're trending towards the right direction. So it was widely expected that probably RBI would want to wait and watch during this announcement. And the next announcement being in February, we could have more clarity in terms of growth, inflation, including for global factors. So towards the end of the this financial year and the beginning of the coming financial year is when I would expect the easing off to happen in terms of rates. Because that's what the inflation has been more or less coming under control. And even retail inflation, CPI has come off, food inflation is under control, and all numbers over there. Apart from that, we have been pleasantly surprised by the GDP growth for Q2, and the outlook for the year has been obviously revised upwards to 7%. So given all these factors, it gives room and space to the RBI to cut. But obviously what needs to be watched very clearly is other global factors also. So how is global inflation, which as of now seems to be coming under control, and how the other central banks react to all these things. So by and large, I would expect in Q4 towards the end and Q1 is when RBI should hopefully look at easing of rates, which is widely expected.
Mr. Tewari, we're going to let you go on that note. Thank you for joining in and taking the time out. Mr. Dugar, just keeping with the discussion, wanted to understand your outlook, given that now, with the Fed policy out of the way, we saw the implications that had on the currency. How are you reading into this announcement today by the Reserve Bank and the kind of hike trend that we've seen or trajectory that we've seen of maintaining status quo? What do you believe that is going to do to the currency?
If the connectivity is bad, if the question is for me, I think you'll have to repeat that again.
I was just talking about your outlook on the RBI rate trajectory on the currency.
Okay, the rupee has remained largely stable if you look at it, and compared to all the other global currencies against the dollar, it has shown a lot of stability and consistency. I think RBI is very clear. The forex reserves are quite comfortable. If you look at the FDI inflow, you look at the FPIs, and you look at the ECBs, all three are reasonably good. While FDIs have moderated, the FPI inflow has been significantly higher, close to $25 billion positive as against negative in the previous equivalent periods. So from that point of view, I think Reserve Bank of India is well prepared both in terms of reserves and in terms of demand supply. So I do expect a period of stability in terms of dollar-rupee rates.
Because globally, of course, we have seen the yields coming off quite sharply from that 5% mark to almost 4.1 within a matter of 3 months itself. But Nilesh, apart from, of course, the policy announcements and all of that, there was also the announcement that they've enhanced the e-mandate limit for MF subscriptions to 1 lakh rupees for mutual funds. I'm guessing you'll be quite happy about it because the SEBI chair is also just speaking about how MF's AUM has crossed 50 lakh crore mark and they are pretty much ready for and gearing up for the T+0 settlement trade as well. What do you make of all of these statements coming in?
As I mentioned earlier, India is ahead on digitization. To shift money from one bank account to another bank account instantly in India, you can use IMPS and it happens without any cost. The same thing takes about $30 for same-day credit in many of the developed markets. We have developed one of the best payment system in the world, which is far less costly compared to most parts of the world. Now, UPI is being enhanced for investment in mutual funds. Certainly, as mutual funds move from India to Bharat, from rich to middle class and lower middle class, this enhancement of limit and convenience of payment will go a long way in helping that mission. As I mentioned earlier, India is ahead in technology and digitization for financial services, and we should continue to maintain that lead with steps like this.
Let's also connect with Abheek Barua, Chief Economist at HDFC Bank, joining in on the show. Abheek, let's get in your take as to how you've read into the comment coming in from the Reserve Bank, because as we said, with the inflation projections, GDP projections, it seems like the market clearly is taking to it well.
Well, I thought it was a fairly neutral policy and pretty much on expected lines. Possibly I'm reading too much into it, but I thought that the commentary on liquidity was a tad more dovish than what I had anticipated, because I think there was a clear reference to the fact that liquidity had tightened more than what had been envisaged in the October policy. So I think that is specifically good news for the market. And this comes in the wake of a series of discussions that the RBI has had with banks and FIMDA and so forth as to how to ease the liquidity bottlenecks in the market, the asymmetry in liquidity and so forth. So I would think that the implicitly, and again, I sort of would caution you that I'm perhaps reading too much into it, that the RBI is telling us that it is not that comfortable with the extreme negative liquidity balances that we've seen in the past. So that is certainly good news to the market. again, the forecast that the RBI has provided, which is pretty much in line with the Q2 numbers, I think are good news. One of the things that I noticed that for fiscal 25, the Q2 and Q3 numbers are far more buoyant than what we anticipate and indeed what the market has anticipated. So it's kind of not building in too much of an impact of a global slowdown. And, in a sense, I think all central banks are facing this conundrum of, letting their, taking their eyes off the ball and running into trouble. And on the other hand, staying tight for too long. The RBI has reflected a similar, dilemma. But I think it was a little softer, more dovish, whatever you want to call it, than the earlier policies. And I think slowly the RBI will make space for monetary easing. It will not come immediately, but I think a couple of policies from now, we might just see some decisive action on the ground.
Interesting. Just hold that thought. Wanted to take a quick check as to what the markets are doing as well. So 20,988 for the Nifty. It's a bank Nifty rather, which is actually firing away a 260-point rally on that one. Bank of Baroda, IDFC First Bank, HDFC Bank for that matter of fact, PNB, IndusInd Bank, they're all rallying quite well for themselves, and even JSW Steel from the frontline index is high by 3.5%. NTPC is something that we are watching out for, even though Bajaj Finance continues to be on the back foot. This entire news on the web aggregators, let's see if it has had any impact on any of the Paytms of the world or any other microfinance players, because of course, we are trying to analyze the impact of that as well, though not a direct, corollary, but nonetheless, there might be some sort of impact. But for now, holding up in the green. Separately, it is IREDA, which is actually perked up suddenly 14% higher, and JMR is the other one, which is higher by 12%. Abheek, I wanted to scratch that point further with you. You talked about how probably easing and a decisive action could take place. Are you talking about a rate cut and as early as Q1 FY25 or even earlier?
Q1 25, I think the RBI would like to err on the side of caution. But the general feeling is that the RBI will kind of synchronize with the Fed. And if you believe that the Fed will not cut before H2, then the RBI is kind of wedded to that rate path. But given conditions as they are emerging, the relative resilience, the kind of inflation path that they have projected, we might just see one towards Q2 of calendar 24, which can be justified, and we need not necessarily synchronize with the Fed. And maybe a lot of stuff is happening through the liquidity channel. For instance, if you look at the effective policy rate for the last couple of months, it's actually been 6.75 and not 6.5, because that's where the overnight rate has settled because of the tight liquidity situation. So instead of going in for an explicit cut, we might see liquidity management start as early as Q1 of last year, which ensures that the overnight rate kind of settles closer to the repo rate, and then perhaps even drops a little below that because you have persistent surplus liquidity. So I think instead maybe they'll hold off on the rate cut, but through the liquidity channel and on sort of managing the overnight rate through the liquidity channel, we might see some relief coming in before an actual rate cut is announced.
Finally, Nilesh, let's just get in your take, given that we've been ticking off all of the points as to how the India growth story looks very promising, especially now compared with the rest of the globe. What is the trajectory for the markets in light of this? Only building on to the current gains?
So as a childhood memory, I'm sure all of us would have watched a serial called Star Trek. And Captain Kirk there mentioned that the mission of USS Enterprise was to boldly go where no man has gone before. Our market is also mimicking something like that. The large cap valuations are reasonably around averages, but the mid and small cap valuations are trending above large cap, above their historical averages. And probably in small cap, we can say that they are boldly going relative to large cap where no man has gone before. I just hope and pray as Nifty is touching 21,000, it's little below, but it did touch 21,000. It behaves like an adult person and not like a teen.
Is what you are expecting from the market, but it is known to be irrational at times as well. Let's see which way it goes. But Kaustubh Gupta is also joining us from, ABSLMF as well. Thank you so much for joining us. I just wanted to begin by asking you, Kaustubh, your takeaway and your reading of the RBI commentary today. What really stood out?
So look, this policy is very much on the expected line, and for the first time in last 2-3 policies that RBI has not given any shock to the bond market specifically. We think that this policy is basically ensuring that RBI focus remains on ensuring that financial stability is secure, which is very necessary to secure the long-term growth and macro variable. From that perspective, I think it's a prudent policy. It is basically a counter-cyclical policy. And RBI is now fine-tuning their both liquidity operations and even by various measures that we have seen over last 1 month to make sure that there are no bubbles which are evolving. We do think that this is a status quo is likely to remain stale on rates at least for 1 year. I would agree with the previous speakers that liquidity for now is tight, and we do expect liquidity to remain tight for next 6 months, which means that markets which were worried for large almost sale by RBI, that probability RBI has brought down quite significantly in today's policy.
All right, gentlemen, good to have you on board. Thank you so much for taking time out and joining in and assessing the RBI policy on expected lines. And clearly, the market has digested the news well.